Well, the CPI numbers are in, and even though they fell within the expected range, there's still plenty of surprises and plenty of things that could happen. So stay tuned. I'm going to go into the numbers in a second. In the meantime, if you want to stay on top of these changes in the economy and how it affects your crypto, your stock market, your real estate investment, your personal finance, make sure you like and subscribe to my channel. Let's get started. So the BLS issued their numbers for this July CPI, and really we're expecting like 2.8%. They came in at 2.7%, and the core was expected to come in around 3.1, and it came in at 3.1%. So let's look at the actual BLS report that came out. So here's what we have. So the consumer price index for all urban consumers increased 0.2% in July after rising 0.3% in June. So it seems like the price increase are slowing down a little bit in July compared to June. So this is a positive note, but the prices are still creeping up. All items index increased 2.7% year over year. The index for shelter rose 0.2% in July. The food index was unchanged over the month. That was a little bit of a surprise on my side. Energy fell 1.1% in July, as the index price for the gasoline decreased 2.2%. This is not the year over year, this is the month over month numbers, went down 2.2% over the month. So the index for the core CPI rose 0.3%, following a 0.2% increase in June. So in this case, it's actually accelerating on the core CPI. Indexes that increase over the month include medical care, airlines, airfares, recreation, household furnishings, and used cars and trucks. What you see from the core here is that there's really nothing that seems, it looks like tariff has not affected the core too much. Maybe household furnishing, there's a little bit of something there. I don't see anything about the tariff impacting the inflation. Mentioned that the energy index decreased 1.6% over the 12-month ending in July, and the food index increased 2.9% over last year. So that's what we're seeing there for the numbers. In June, what we saw the CPI was up 2.7%. It was really led by shelter and energy, and the gasoline went up 1% in June. Core CPI went up 3.1%. So what is the source of the inflation? We had, just to recap, on June 4th, we had the steel and aluminum tariffs go up from 25% to 50%. In June 12th, the steel tariffs actually included all the appliances. We had a China tariff reduction from 135 to 10% in May, I believe. The thing is that if we expected the tariffs to cause inflation, then we should have seen the big changes in appliances and new vehicles. And we haven't seen that. In fact, the appliances went down, the new vehicles actually were flat. The used vehicles went up a little bit by 0.5%, but the new vehicles were absolutely flat. Again, no big tariff impact to the inflation, which is a little bit surprising to me. And then you have kind of like two camps. One camp that think that, yeah, tariffs shouldn't affect inflation. Then you have another camp that looks at the annual reports for companies like GM, Ford, Caterpillar, etc., and they're realizing that, well, someone is going to eat the tariff, and who's that going to be? So we're seeing that, and that other camp think that, well, there's going to be some delay before we see the tariff come into effect. Also, the big worldwide tariffs went into effect only in August, so it didn't affect anything in July, and that's going to come through in the next few months. It's not going to be a big one bang thing. Tariff is going to go up, and then it's going to cause whatever price changes need to happen, and then we can forget about it. All right, let's look at some reactions here on Bloomberg. Headline inflation slowed in July to 0.2% monthly pace, matching the forecast. It was helped by 0.1% dip in groceries and a 1.1% decrease in energy costs. Part of that energy cost drop was the gasoline prices, which dropped 2.2%. On a year-on-year basis, the headline inflation is held at 2.7% against the expectation to pick up 2.8. So it looks like that headline inflation is actually slowing down a little bit, but still going up. Stripping out the food and energy, basically the core CPI, that accelerated at 0.3% on the month. So this is pretty significant. A number of goods categories showed a waning impact from tariffs. So furniture and bedding rose 0.9%, but prices for appliances fell by 0.9%. Apparel barely nudged higher also, so it's something we kind of expected that to have an impact from the tariff also. Some comments here from Mary Daly, the president of San Francisco Fed. A 25 basis point cut in September seems to be the base case. Can the Fed cut rates when inflation is going up? Yes, it can, as long as the tariff inflation is seen as a one-off price adjustment. But I don't know how we can see that as a one-off price adjustment, because there's going to be lots of changes in tariffs in the coming months that we know about. We haven't factored in the August tariff changes. I'm sure that Trump is going to be changing tariffs worldwide on a whim for different reasons that we can't predict. So I don't think it's going to be a one-off price adjustment. I think we're heading into a situation where these tariffs are going to be all over the place and are going to cause havoc on the economy. Labor markets is in balance, even though we're seeing some softening, and we're also starting to see some sentiment come down. This leaves us obviously more vulnerable. She's thinking back 2019 when they cut the rate twice, and because there was some headwinds from overseas, and she sees this today, today's market as being very similar. I mean, to me, the big difference is that these tariffs are much more disruptive than just a price increase. In her judgment here, she says that the only difference is the inflation was 1.8% in 2019, and now it's significantly higher. So I think we are in a very, very different environment than when we were in 2019. I kind of disagree with that slightly, but so if we're lowering the interest rate in the face of rising inflation, then the burden is on us, I guess the Fed, to explain that we're not seeing persistence and to offer what is true. That it turns out to be persistent build, then we're just going to go turn around and raise the interest rate again. Oh yeah, it's worth noting that two categories that Trump tends to emphasize, groceries and energy, both fell in July. So it's something that's very important. I'm sure this is something that they're going to heavily focus on. So the food at home was down 0.1% and the energy prices were off by 1.1%, with gasoline dropping 2.2%. We still have the personal consumption expenditure price index that's due in a few weeks. This is really what the Fed is looking at when they're looking at inflation. They're not so much looking at the CPI, and the inflation target is focused, the 2% is focused on the PCE, not so much the CPI. With the new weaker light shed on the labor market, maybe just avoiding upside surprises on inflation is enough for the market to continue pricing in more rate cuts. If you look at the stock market, you can see that it went up dramatically this morning on the news, expecting more rate cuts, and that's basically all they needed. Be happy. Obviously, rate cuts is going to stimulate the economy. So new vehicle prices were flat on the month. The auto industry is anticipating a pickup in prices when the new model year comes online this fall. And the thing is that they're currently working out their inventory, things that were built before the tariffs were in place. And this is why we're not seeing any kind of like price increase on the new vehicle. As the new vehicle are coming online and they're being built, they're using components, they're using steel and aluminum that are affected by tariff, and we're going to see how that goes. We've already seen the earnings report from GM and the one from Ford, and the cost of tariff was absolutely tremendous. Like the GM was $1.1 billion in tariffs for Q2. Ford was about $750 million in Q2, and this is expected to go even higher in Q3 because a lot of these tariffs were not factored in yet. We expect to see hotter new vehicle prices tied to tariffs ahead, however, as new models hit dealership and pre-tariff inventories are drawn out. The concern for the Fed is that with inventory rundown, the tariff-induced boost to inflation is likely to grow over the coming months. Right now, they're not really seeing a tariff-induced inflation. They're not seeing the impact. But as the inventory is running down, they're likely to see these tariffs have an impact on the prices. Core goods are the real driver of the move up in the index, while being somewhat offset by energy and shelter. The report will likely not change the path forward for the Fed, as we expect to see rate cuts at the next 3 meetings. The tariff impacts on inflation looks like it will take longer than expected, a slow burn rather than a big bang, and I tend to agree with that. We're still sifting through the categories to assess where tariffs are surfacing. Just some example of sectors where you might expect tariffs to surface would be furniture and bedding. That rose 0.9%. But prices for appliances fell by 0.9%, which was a surprise. Apparel barely went higher. So the men's shirts and sweaters fell by 2.6%, and women's clothes rose by 2.7%. The story is far from clear. Defenders of tariffs will say, on one side, you're going to say that the goods inflation backs up the view that the trade policy is not driving up prices, and you have another camp that is going to say that, well, we haven't seen this yet. We still have to work through the inventory that we have, and then the prices will adjust in the months ahead. This CPI report is really not changing that perspectives. Household furnishings are among the categories economists have been watching for tariff effects, and the gain there is 0.7% on the month, which marks a little bit of a slowdown. Some of the implications. So the Fed's mandate is to maintain employment and keep price stability, right? But when we look at this, yes, we have a softer labor market, but really it's not that bad. We have 4.2% unemployment rate. We're close to full employment. Don't see too big an impact there. Then we're looking at the inflation numbers. Yes, the core inflation went up 3.1% year over year, but it's still pretty stable. When we're looking at the full CPI, it's actually kind of slowing down. So this is the good news on that side. With higher core inflation, this complicates the case for a rate cut, especially when we're looking at the mixed labor market. I would want to stimulate the economy to create more jobs, but if I stimulate the economy by doing a rate cut, then that means also that's going to push the inflation higher. So the Fed doesn't want to necessarily do that. In a normal administration, the Fed would probably not be cutting rate at this point. But right now they have a lot of politically motivated people in power that want to see the Fed cut rate for one reason or another. We have a big disconnect between the government and the Fed right now and the economists. The government is painting a picture that the inflation is great, the groceries and the energy prices has gone down. Don't worry about the labor market. The BLS person was it's all fake numbers. Don't worry about the softening in the labor market. Everything is fine. The economy is great. We have the best economy in the world. Didn't they want to have the Fed cut the rates, which doesn't kind of jive with what we want to do. If the economy is doing so well, if the labor market is doing so great, there's no need to stimulate the economy then by having the Fed cut rate. If there's a rate cut, that's going to weaken the dollar also. In terms of mortgage, if the inflation expectation is kind of like moderate right now and we have a Fed cut, that means that we can expect potentially lower mortgage rate, but it could also mean higher mortgage rate. The Fed is not controlling the mortgage rate. In terms of crypto, if the Fed cuts the rate and the lending rates go down, then investors can feel that they can take more risk. That would mean an influx of money into the cryptocurrencies like Bitcoin, like Ethereum, or something like that. What should we do about it? In terms of crypto, as I said, I think I'm expecting increased demand in crypto. That means that if you want to buy Bitcoin, Ethereum, this might be a good time and ride the wave up. I would probably avoid stable coins because if we're going to lower the Fed rate, we're seeing some kind of increase in inflation, then the US dollar is going to go down. That means that the stable coin is also going to go down. With these changes also, that means that short-term US treasuries where the stable coins are invested is also going to go down, and the yield is going to go down. So that means that the issuer stable coins, their profit on the stable coins is also going to go down because they get paid on the short-term US Treasury bill yield. In terms of real estate, it is always the best place to hedge against inflation. This is something that I highly recommend. Get into the cash flowing rental real estate market. It's a real asset that has intrinsic value, and then if you use leverage on top of that, you kind of multiply your cash flow, you multiply your appreciation, and you maximize your hedge against inflation. And we're expecting the mortgage rates to go down in this situation. This is something I highly recommend. If you're thinking of buying a home, I would recommend that you hit the pause button on that, stay liquid, take advantage of the opportunities that are out there, and be able to get in and out of a market situation because it's going to be highly volatile. You want to diversify into different asset classes. You definitely want to have real estate as part of your portfolio to create some stability and inflation hedge. And then you can invest the rest of the money into the stock market and crypto, etc. But in the stock market, you want to stay defensive. I expect still a significant correction by the end of the year. So the situation continues to evolve. There's lots of things going on with respect to will the Fed cut rates, what's going to happen with the PCE, what's going to happen to crypto, what's going to happen to the mortgage rate. If you want to stay on top of what's happening, make sure you like and subscribe to my channel, and see you next time.